Hey, Michael Dermer here, and in this lesson we're going to be talking about valuation. We hear this term thrown around a lot, and what it essentially talks about is how you value your company when you're ultimately raising money to determine when you bring in money how much ownership you're going to give away. So let's get into it. So we're here to talk about valuation. Valuation is a really difficult thing in an early stage company. And when you get into what are the different factors that determine the value of their company, they're really more art than science. So I'm going to walk you through a bunch of them. Okay. One of the factors is industry demand. In other words, what is the demand for your particular product or service, right? And if there's a high degree of demand for your service, obviously that's going to make your company more valuable. Okay. Next is market size, right? How big is the market that you're going after? If you're going after the entire pet market, that's going to have an impact on your valuation versus going just after the dog market, right? So the size of the market opportunity that you have is also a key factor in valuing your company. Next is, what stage of development are you at? In other words, are you just getting started? Do you have your product or service ready and available? Do you have lots and lots of customers? And maybe you even have some really good financial performance. So the earlier stage your company is, in most cases, the lower your valuation is going to be. And if you're further along and you've shown more traction, then it's likely that your valuation is going to be higher. Next is what actual traction and market presence that you have. So for example, if you have actual paying customers, you have a lot of press coverage, you've built a brand, anything that demonstrates that that the market is receptive to your particular product or service. If you're able to come to the table with lots and lots of customers and lots of press coverage and lots of partnerships, it's much more likely that you're going to have a higher valuation. Another factor is talent. So one of the reasons why investors make investments into businesses is because of the team. And if you've been able to bring onto your company, talented people to work on your venture, that is also something that has a positive impact on valuation. Another factor is comparable companies. What investors like to take a look at is, are there similar types of companies in and around your industry that are a good indicator of what this company might be valued at? Now, obviously, we all believe what we're doing is different, right? And we do believe what we're doing is different. They're not exact comparisons, but people like to look at similar types of companies to get a sense of what valuation might be. Another factor is your pricing or your business model. Valuation is dependent a lot on your ability to generate sales and have those sales be woven into profits, right? So if you have, for example, a technology platform that's been built that when somebody pays for, right, it generates lots of profits. That's very different from having, for example, a manufacturing company where you're manufacturing cars, right, where there's lots of labor and capital that goes into it. And perhaps profitability isn't as great. And so your business model, your pricing model is also a key factor. The more kind of technology enabled and scalable it is, the higher the valuation is likely to be. Another factor that certainly plays into this, in addition to all these other factors, is investor demand. If you have a situation in which you have multiple investors really interested in your company, you're essentially creating a bidding war and a bidding market for your company. And so even though you have all the other factors we've talked about here, like the economy and your market size and your pricing model and your team and your traction, one of the things that can have a really big impact on valuations if you have multiple folks vying for your company. Okay, so there's ways to create momentum and demand around that. So a lot of times people can come to the table and understand that they're competing with other people to make an investment into your company. And finally, and again, this is one of those things that's more art than science, is a sense of urgency, right? You'll have situations where is there an urgent need for this investor to make that investment? And that urgency can also spur, as you can imagine, a lot of additional demand and higher valuations for your company. So in addition to the factors that go into valuation, there's a couple of methods or methodologies that I'll touch on briefly here about how companies are actually valued, right? One is called discounted cash flow. And what discounted cash flow actually looks at is it goes and looks at projections over, let's say, 3 or 5 years, and it looks at the cash that the business is going to generate. and then it discounts that back to today. So it's essentially what a lot of investment bankers use to value companies based on the cash flow that's going to come in the future. Okay. Next is a multiple of earnings, right? Or sometimes it's called a multiple of EBITDA. And all EBITDA is a phrase that means your operating income. Okay, and so what companies will do is, what investors will do rather, is they will come in and they will say, okay, how much money are you generating? How much actual earnings are you generating, right? And so if you're generating, for example, $1 million in earnings or EBITDA, depending on the type of company you are, they will value you as a multiple of those earnings. That multiple usually ranges from 5 times to 15 times those earnings. So for example, if you had $1 million, right, in earnings, and you got valued at 10 times those earnings, that would be a valuation of your company of $10 million. Okay. Now, why is it 5 versus 15? 5 tends to be very traditional businesses, lower margin, and 15 tends to be highly technology enabled businesses with very, very high margins. Okay. And there's everything in the middle, and there's a bunch of other factors that go into that range. Okay. Another method that's used on occasion, although not that frequently, is a multiple of revenue. So for example, we talked about before a multiple of earnings. And so if you have $100 in revenue and $1 of earnings, it's valued as a multiple of earnings. In rare cases, it's valued as a multiple of revenue. So in my example, a multiple of $100. This tends to be for really, really high growth businesses and kind of sexy industries where the revenue growth is really showing the potential of the company, and it's not so much the bottom line earnings as we talked about before. One other method that's often used is looking at similar types of transactions in industries. So investors will look to other types of deals, whether it be equity investments made or mergers and acquisitions that are done, that ultimately give an indication of what these types of companies are valued at. So these are the different methods that are most commonly used to value companies. And what you'll see and you'll come to understand is this is more art than science. I mean, valuation is a complicated concept. And how a company gets valued is a multiple of all these different factors, as well as those different methods that we talked about, discounted cash flow, multiple of earnings, multiple of revenue. And so in addition to this video where we kind of walk you through the high level stuff, there's a whole bunch of detailed information written out in this lesson that hopefully will give you a little better sense of what we mean by valuation and how most investors use it to calculate their investments.